Okay, folks. How many of you are in my corporate finance class as well? Now, when I originally set the quiz dates, I did not realize how many people were taking both classes. As you know, the second quiz is in the same day, the third quiz. The problem is once I put the quiz dates down, moving them becomes problematic because then people have this thing of, I did my whole life around that date, now you moved it. So I wish I could do something differently, but I've learned. So next year I will try to figure out a way to kind of stagger them because my undergraduate valuation class, I'm giving the quiz today. I thought a little bit about doing it for this class as well, but that ship has sailed. No. So I'm sorry, but not much more I can say beyond that because at this stage I can't really fix that. So today we're going to keep doing valuations and we're going to get deeper and deeper into actual companies and issues you run into. So I'm going to start with an issue that you run into, not just with emerging market companies, with companies that you feel have poor corporate governance. Remind me again, what does that mean? What does poor corporate governance mean? Yes,
Which is less than accountable to shareholders.
Okay, less than accountable to shareholders. And how would we measure that though? I mean, in terms of
The ability, I guess, the ability of shareholders to the board of directors.
okay, so now we're talking. So when managers are not doing a good job, what does corporate governance allow you to do? Replace management, ultimately, right? Holding them accountable is the first step, but eventually replace them. So if you have poor corporate governance, what does that mean? Even if the management is doing a job you don't like, there's not much you can do about it. Why would that be? Because you have different classes of voting shares, because you're in a market where corporate governance is weak, because you have structures that make it difficult for shareholders to check. Lots of different reasons. So let's say you're valuing a company with bad corporate governance. So it's badly managed and badly run. So that doesn't always go together, right? Can you have a company with bad corporate governance with great management? Yeah, sure. Right? Can you have a benign dictator? Absolutely. The only problem, though, is benign dictators become malignant dictators and good managers can become bad managers. 10 years ago, people wouldn't have blinked about giving, Mark Zuckerberg the supreme power to run Facebook, or Sergey Brin and Larry Page the supreme power to run Google. But now they're saying, I wish we could check them. But you gave away the store, right, by having voting and non-voting shares. So you have a company with poor corporate governance, badly managed and badly run. You've done the discounted cash flow valuation. By you've done the cash flows, the discount rates, you come up with a discounted cash flow valuation of 100 million. Should you discount that value for corporate governance? Yes.
It don't show up in the other ones.
Tell me where, because you did the DCF, so tell me where it showed up in your numbers. Where does bad management show up in a valuation? What does bad management do? Well, you take project with a return capital of 5%, the cost of capital is 10%, you don't care, right? So when you did your DCF, the question I'm going to ask you is, did you build that in? If you built in a low return on capital and a terrible debt ratio, this company doesn't borrow money because the managers don't like debt, and you kept that as is, that 100 million already reflects the value of poor corporate governance. When you do the DCF, you know what you've built in. So if you ask me, should I discount it? I'm going to turn it back to you and say, should you? I mean, you've done the discounting. I'll tell you when you might have to discount it. I find this practice in DCF to be troubling, which is people take a company and they will replace the actual target debt ratio with a target debt ratio. They would take the bad return on capital and make it into a good return on capital on the spreadsheet. If that's the way you value the company, then you should discount it, because how is that going to happen without anybody putting pressure on the management? So today we're going to talk about how to quantify the effect of poor corporate governance and how it's going to show up in the market in market prices. Come on, we're also going to talk about distressed companies. Very depressing valuations, valuing companies in distress, because there's a sword hanging over the company. The company might not make it. Undaunted, you sit down and you fix the company again on your spreadsheet. So tell me what you'll do with a troubled, distressed company to fix it on your spreadsheet. You're going to take your margins, which might be low or negative, and raise them to industry averages over time. You can take the debt ratio that might be 80, 85, 90% and bring it down to a healthy debt ratio. Let's say you do everything by the book, my book or any other book. You fix every problem, you make the company into a healthy, going concern by the time you get to year 10. Then what do? You launch it off into eternity. It becomes a terminal value, a perpetual value. And then you take the present value to come up with the DCF value for that distressed company. You've done everything right, the way you were supposed to do it. Your discount rate reflects the risk of the company, it reflects the changes you see. Is your DCF value going to be reasonable, or is it going to be too low? Or what is, if it's going to be too high, you need to tell me what I'm missing. If it's too low, you need to tell me what I'm missing. If it's reasonable, then we're done. So do you think it'll be too low or too high relative to the true value of the company? What do you think, Lambert?
Too high.
And tell me what I'm missing when I.
So for the DCF, essentially you're assuming going.
I'm assuming the company will make it, right? What am I missing? The chance that it will not make it. And if it doesn't make it, I can guarantee you're not going to get going concern value. You're going to get liquidation value, a fraction of what you think. When we value distressed companies with discounted cash flow models, we are going to overvalue companies if we leave it at the DCF. So Gandhar, what do I need to do to get from a DCF to a fair value of the company? What are the two ingredients I need to bring in?
Take into account the risk of figure.
One is the chance I will not make it, and second, complete the process. If I fail, what do I need to be able
to company?
Tell you what I will get as proceeds if I sell off the company? You might use book value, half a book value, fair value. Basically, I'm looking to see what the chance is. So let's make these processes more explicit. But to do this, I'm going to go back to my valuation of Amazon, because there are a few loose ends I want to tie up, and then I want to delve a little bit into the details of why I used the numbers that I did. I have a story I've told for Amazon. It's an upbeat, uplifting story of a small retail company becoming a really big retail company, going from money losing to money making along the way. Value per share that I got was $35. With the uplifting story, the stock was trading at 84. Now you can see the mechanics of what got me to 35, but the stock's at 84 in spite of my uplifting story. Now, earlier company, when I value a company and I come up with a value which is higher than the price, one very simple way in which you can test to see whether I believe my own valuation, to ask me a question: are you buying, right? So if it's undervalued and I say I'm not buying, what have I told you about my own valuation? Nice number crunching exercise, but I don't believe it, right? That is the ultimate test. Are you buying? Ask me the analogous question here. Let's say it's January 2000. I valued Amazon at $35. You can see the mechanics of what I've done. The stock is at $84. You're trying to gauge whether I trust my own valuation. So Justin, what's the question you'd ask me? Am I shorting? It's exactly the question I was asked towards the end of this webcast. And I'll tell you what I said then, and I will back it up. I said, not in this lifetime. And the pushback was, hey, don't you believe this valuation? I said, I am more convinced that Amazon is overvalued in January 2000 than almost every company that was undervalued the last couple of years that I've bought from my undervaluation. So I'm going to ask a follow-up question. Maybe Justin, you can help me out here. When a stock was undervalued, I'm willing to step in and buy. Why, when Amazon is overvalued and I feel pretty confident that it's overvalued, am I unwilling to short? Time is the key, right? Let's go back to the undervalued stock. When something is undervalued and I buy it, how long am I willing to wait? Only person I have to answer to is my spouse. And I've turned off the reports from my online broker, so she doesn't even know that I bought Tesla 3 weeks ago. So it'll catch up with me eventually. Yeah. You can see why time horizon is not always good. If you're a professional money manager, your time horizon is only as long as your shortest term client, right? I mean, when I buy, because I buy it with my money and I'm willing to wait. How many years? I'd prefer that it be fixed tomorrow, but I can wait a year, 2 years, 3 years, 5 years. Time is my ally. What does selling short mean? What do I do, Behrman? I borrow shares from somebody and I agree to return them. When? Time is left a little fuzzy. When I want them back, I will ask you. So already, you know, the clock is ticking. I knew this question was coming on this one. So I checked around with brokerage houses in January 2000, how long they would give me on Amazon on a short sale. They said, for you, as a favor, I'll give you 6 weeks. Now do you see why I said not in this lifetime? Because not only do I have to feel convinced that I'm right on Amazon's overvaluation, I have to be convinced that the correction is going to happen in 6 weeks. It's one of the great asymmetries in investing. When something is undervalued, there's always a bargain basement long-term strategy of just buy and hold. When something is overvalued, there is no analogous strategy on the other side, or at least one that can be easily accessed. Today, I can actually sell short on Amazon long-term. There are actually leaps, long-term puts you can buy. It's on a subset of companies, a few very large companies, where you can actually go sell short. So it is improving on that. But for most stocks, in most asset classes, when things get overvalued, you just step back and marvel and say, I'm not in that bubble, but there's not much I'm going to do about it. So it's easy when you see, so if you get the implication of this is when you have bubbles, they're far more likely to be upside bubbles than downside bubbles, right? I mean, technically, mathematically, there's no reason why you can't have a bubble on the downside, but things get massively undervalued. But what stops that usually is the bargain basement strategy kicking in. With upside bubbles, not much you can do. But if you can figure out a way in those upside bubbles to do something creative. Now, this class almost was in the auditorium in the other building. Who's that auditorium named after?
Paulson.
Which Paulson? Not the Hank Paulson, who was the Secretary of the Treasury, but John Paulson. How did he get so rich? He shorted what does that mean? I actually tried shorting my neighbor's house in 2007. It didn't work well for me. I said, can you lend me your house for a couple of years? I'll return it to you. Right? The problem with the housing market historically is it's been very difficult to short. So what did he use to short the housing market? He actually created securitized versions of the housing market. It took work, and that's what gave him the big payoff. Is most people look at that, nothing I could do. He actually took advantage of securitization. He shorted the housing market. He made billions of dollars. So when you see an asset class get massively overvalued, if you can find creative ways of shorting that asset class, you probably have a pathway to riches, which you would not get in most of the rest of the market. So let's talk a little bit about this Amazon valuation, because there are lots of details I didn't fill in. Why 42% growth? Why 10% margin? How do I get to 10%? Let me start off, though, by re-emphasizing something I've already said in this class, but you got to quadruple what I said when it comes to young companies. Remember I said don't trust a regression beta for any company? That goes in spades when you think about betas for young companies. Okay? This was the regression beta that I pulled off from Bloomberg for Amazon in January 2000. The raw beta was 2.23. You see, good, second decimal point nailed down. But take a look at the standard error on that beta, 0.50. So if I have a raw beta of 2.2 and a standard error of 0.5, think about the range on my beta. My true beta can be anywhere from 1.2 to 3.2. Regression betas become close to useless with young companies. So you're valuing an Airbnb, for God's sakes, don't look at the Airbnb regression beta. It's going to be worse than the regression beta for most of the publicly traded because it's a young company. So what's the alternative? Look at bottom-up betas. In the case of Amazon, I used two different peer groups for the bottom-up betas. For the first 5 years, remember this was a period where there were a lot of online retail companies, most of which were like Amazon, young, money-losing. I took that subset of online retailers. I took the bottom-up beta from those. That was the 1.60 that you saw for the first 5 years. But by the time I get to year 5, my estimated revenues for Amazon are $15 billion. I'm actually estimating that Amazon's going to be making $1 billion in profits. It's no longer a small online retailer. And my argument is as companies get bigger, the business comes first. The way you deliver that business comes later. If you've been looking at my industry averages, until last year, I had a sector called online retail. This year it's gone. You know how many emails I've got? So what happened? It's gotten to a point where the line between online retail and regular retail has kind of dissipated because regular retailers get 20, 30, 35% of their revenues online. And online retail is basically, retail has become predominantly online, kind of silly to kind of break it up into online and regular retail. And online retail is maturing as a business. But in 2000, two sets of betas, online regression retail betas for the first 5 years, and a traditional retail company beta beyond year 5. Second, and this I think is the heart of my story. I gave you a 42% compounded revenue growth rate as my estimate. I'm going to take you back to January, to 2000 and end of 2019 when I was trying to do the valuation, and talk a little bit about how I started the process and why I had to give up. The way I was taught to do valuation is sequentially. You know what I mean? Sequentially, you do year 1, then you do year 2, then you do year 3. And I tried that with Amazon, and I was tearing my hair out and going crazy because I was uncertain about year 1. Forget about year 2, year 3. I was saying, I have no idea. So I had to switch gears. I said, this isn't working. I can't move through time. There's too much uncertainty. So this is going to sound mildly Deepak Chopra-like, and I hate the guy, but kind of hang in there. I had to visualize what success would look like for Amazon. I liked Amazon as a company. I thought, what does a successful Amazon look like? In 2000, as I confessed, I assumed that Amazon was going to be a retail company. So if I wanted to visualize what successful retail companies would look like, I couldn't stay in the online space. I had to go to brick and mortar retailers. So I made a list of the top 20 retailers in the world in terms of revenues. And I asked myself, where on this list would I think Amazon would fall? The biggest retailer in 2000 was Walmart, 200 billion in revenues. I said, will Amazon be like Walmart? And at least in 2000, my conclusion is they're a different business model. They're not a discount retailer going for high revenues and low margins. That's not where they're going to be. I picked, specialty retailers like J. Crew and The Gap. And I said, are they going to be? I said, they're going to be bigger. They're not just in apparel, they're in multiple. So almost by this process of trial and error, I ended up making them between the 5th and 6th largest retailers in the world. Guess what the revenues for those companies was? About 40 to 42 billion. So I knew where I wanted to be. I knew where I was. You know what my growth rate was? It was a way of getting from where I am now to where I think they will be as a successful company. You think, how do you come up with these growth rates by year? I made them up. And I have no shame in admitting to it. And if you made a big deal about any of those numbers, I'll concede it to you. So in year 1, you said, you know what, revenue growth will be 163.35%. You can have it. You want year 2, take that too. You give me the starting and the ending numbers, I control this valuation. With young companies, it's the end game that drives your value. not the year one, the year two, the year three numbers. So if you had a very different end game vision for Amazon, you thought they'd be as big as Walmart, you'd get a different value. But this is not a disagreement about growth rate next year. It's a disagreement about what will this company look like as a successful company. The only rule I followed in doing these growth rates is as the company got bigger, the growth rate got smaller. It's just a math rule basically to reflect the scaling of the company. So any questions on revenue growth? Now you can see why if you're valuing a young company, the task for you is to figure out the market and the market share. Said this is what success will look like at my company. Let's move to operating margins. Right now, the margin is minus 36.7%. In steady state, as I said, I assume their margins will move towards the 75th percentile of retail companies, and that margin is 10%. Again, remember, when I started the spreadsheet, I have two numbers. I have my number now. I have the number I want to be in year 10. I have to fill in the remaining nine years, this blank cells there. And I did not want to do it year by year because, again, how the heck am I going to forecast operating margin year one, year two? But it looks like I pulled it off, right? Good. Second decimal point nailed down. I'll make a confession. All those numbers between years 1 and 9, years 1 and 10, I just gave my spreadsheet a very simple algorithm to work from where I am today. So all I had to do is starting number, ending number, the algorithm. So I'd like you to guess what that algorithm is that allowed me to go from minus 36.7 to minus 13.35, minus 13.35 to minus. What am I doing that's coming up with these intermediate numbers? And don't think exponential log, nothing that sophisticated. It's much simpler. It's based on a childhood game. Where am I now? Minus 36.7. Where would I like to be? Plus 10. What's the distance between the 2 points? 46.7. I took half the distance. I'm at minus 13.35. Where do I need to be? 10. I took half the distance. You say, why half? Why not? Now, when I build spreadsheets, let's face it, I don't have a crystal ball, but I want to design in a way where if you disagree with me, you can change it. What this allows me to do is bring into my story the pathway to profitability. I'm mapping out a pretty smooth pathway to profitability. If you disagree with me, let's say I agree about every other part of my Amazon story, but you say, look, you're underestimating how difficult it's going to be for them to get to be money making. You can replace the half with a quarter. If you move a quarter of the distance each year, I'll start with the same number and end with the same number, but I'm going to lose more money for a longer period before I get there. There's your rockier pathway. If on the other hand, you think you're being too pessimistic, you make that 3 quarters, you're going to move. You can even say, look, I'll get to 10% next year. That's an incredibly upbeat view. Just set it to 1. You'll be at 10% next year. So whatever mechanism you use, make it a mechanism that if people disagree with you, they can change it. Don't hard code it. Don't build in elaborate black boxes because then you will forget what you actually did. And if you disagree with yourself, God help you there. Yes, Justin.
For the revenue growth.
Yeah.
What kind of algorithm?
Nothing. That's why if you look at my spreadsheet, I ask you for a revenue growth rate for the first 5 years. Now, what you should really be focusing on is the end revenues, because that number to me is just a vehicle, a switch I use to get to my end revenues. So my Tesla valuation, you see that 5-year growth rate for the next 5 years keeps dropping with each Tesla valuation. It's not because I'm getting more pessimistic. It's because if your current scale increases and my end game is not changing, my revenue growth rate will go down. Yes, David.
Is there no rule of thumb as to how these companies with negative margins get to their goals?
It's very idiosyncratic. That's the problem. You could probably do it by sector if you have enough data and you have to account for the failure. It is very much a function of the sector and the management and the business model you pick. So if you pick a business model that's more focused on profitability and less on growth, you will settle for lower growth and you get to margins much quicker. So that's where you can bring in the trade-offs of what are you factoring in? Are you a scaling machine or are you a company trying to design to build profits?
So in this case for you, it wasn't worth it trying to establish this?
Yeah, I don't think it would have made much of a difference in value. If you gave me the 42 billion and the 10% target margin, I'm going to be 90% of the way towards $35. We can debate about the $2 or $3, but it's not going to make big differences. Oh, incidentally, on this page, I have as the operating margin goes from negative to positive, the operating losses become profits. But if you look at the first 3 years, I pay no taxes, but I also keep track of my net operating losses over time. So this becomes a process, but the NOL is not some side player you bring in at the end. It's built into my cash flows in the form of tax benefits. Now, as I do all of this, I have to remember that the story I'm telling for Amazon will make it an exceptional company. Because the history of business is, as you scale up, it gets more and more difficult to maintain growth rates. In fact, one of the most fascinating studies on this was one done on IPOs about 20 years ago that looked at the revenue growth rate of companies just after they go public and compared them to the revenue growth rate of the sector they're in. So the first year after they go public, no surprise, IPOs are much higher growth rate. They're the high growth companies. And then it tracks these companies 1 year after the IPO, 2 years, 3 years. So 1 year after the IPO, the revenue growth rate is down to 7% higher. 2 years later, it's 3% higher. By the time you get to year 4 or 5, this high growth company is now looking very much like the sector. Most companies, growth scales down to either the industry growth or market growth very, very quickly. And the reason is simple, right? You come in, you're a niche business, you have this great business model, you have great growth rate, you go public, everybody notices your high growth, and they try to do exactly what you do. So unless you have significant barriers to entry, this becomes part of your story. I'm a young company, I have great potential, but I also have things that would stop people from. The question I always ask entrepreneurs when they come in with an idea is, because usually they get, what do you do if things don't work out? I'll ask them, what do you plan to do if things really work out? So what? It's a good thing, right? Hey, what if revenues grow 300% over the next 6 months instead of 100%? What do you plan to do? First, you got a cash flow issue now. Remember, as your growth increases, you actually get more negative cash flows. Second, people notice you have 300% growth. They're going to try to do what you do. What is it you have in place to deal with that potential competition? So that's going to determine whether your company is going to be like the typical company. So I know some of you feel constrained by the fact that I don't let you grow past year 10, a spreadsheet. You're welcome to actually take the spreadsheet. It's fixable. You can make it a 15-year growth period. The reason I limit it to 10 years is if you look at the history of growth periods for growth companies in the US, and you can go back 50 years, the median growth period for a growth company in the US is 3 to 5 years. 10 years is about the 90th percentile already. So if you can't get your money back at that 90th percentile, where's the icing left on the cake for you? So it is true there are companies that grow for longer than 10 years, but they should be the exception rather than the rule. Now, as you map out this pathway to make your small revenues to big revenues, don't forget that lesson we had with growth. You have to pay for growth. You have to reinvest to be able to grow. And that's where the sales to capital ratio goes. As I said earlier, when we talked about this is perhaps the shakiest. There are two numbers in my discounted cash flow valuations that are the shakiest numbers. I'll admit them to you. One is this sales to capital ratio, because we have no sense of what's high, what's low, what's driving it, how it changes over time. You can look at industry average, but huge variations even within industries and across time. The other is the failure rate. We'll come back and talk about the failure rate more specifically. But the sales to capital ratio is just a vehicle to capture how efficiently your company delivers revenues. The higher this number, the more efficiently you're delivering revenues. Here I've used the sales to capital ratio of 3 all the way through. Does it have to be constant over time? Now, Lambert is doing a company which is going to have shrinking revenues in years 8 and 9 in his forecast. Now, he's planning to put in a really, really high sales to capital ratio. You know why? Because when you shrink your revenues, your reinvestment becomes a source of cash. So if you leave that number low, it's almost like you get cash inflows from selling off things. And nothing to sell off, there might be no reinvestment. So in a world where you think things will change in sales capital, there's nothing that stops you from doing 3 for the first 5 years and raising it over time if you think the company will become more efficient, or lowering it over time if you think the business is going to get more competitive. But one thing that you can do to check your own numbers, and it's because it's easy to kind of lose track of what you're actually building, is I mean, and this is, one of those little secrets in DCF that we tend to forget is when you put in something as reinvestment into your free cash flow, that's actually your delta in invested capital. So if I were building an invested capital model, that reinvestment is my delta in invested capital. So if I keep track of my invested capital over time by adding that delta each year, and I have my expected after-tax operating income, I can actually compute what I call an imputed return on capital. I don't actually use it, but it's actually coming out of my own assumptions. You say, what do I do with that? The case of Amazon, my imputed return on capital by the time I got to year 10 was 20.39%. Question I had to ask myself is, am I comfortable with that return on capital for a mature company? This is 2000. The T-bond rate was 6.5%. Retail businesses had returns on capital on average of about 18%. I looked at the 20.39% and said, I can live with that. But you know what I would not have been able to live with if that had been 200.39%. What's my spreadsheet screaming out at me? If I have a 200.39% return on capital, you're not reinvesting enough, right? And if I'm listening, what's the easiest metric to change to make myself reinvest more? Go back to the sales to capital ratio and lower it from 3 to 2.25. There is a feedback loop. This is actually in the spreadsheet. In the very bottom line, I keep track of your imputed return on capital. If you feel you're overshooting, you can reinvest more by just bringing down the sales to capital ratio. And earlier, as the last class, we spent a lot of time talking about this. The dilution is already in there. Where? If you look at the discounted cash flow valuation, first 6 years are negative cash flows. As an experiment, take those cash flows, zero them out. The discounted cash flow value for Amazon you'd have come up with would have been $20 billion. It's actually $15.2 billion. You've actually discounted the value by 25% for expected future negative cash flows, which is just another way of saying you've factored in the expected dilution. If you adjust your share count as well, you'll be double counting that same dilution. That's why we can get away with using the existing shares. And if you have option grants, by subtracting out the actual option value from your equity value, again, you're dispensing with the need to forecast out the additional shares outstanding. So it stops the gaming around, should I use primary shares, diluted shares, partially diluted, just go with the primary shares, but clean up as you go along. Now, when I valued Amazon, I did say that I was being optimistic. But in my defense, I was doing this in January 2000, where people were just, .com was the place to be. It was upbeat time. That's why when I did my discounted cash flow valuation, I got those negative cash flows the first 6 years. I pretty cavalierly assumed that those cash flows would be covered by new capital. So what's the problem? .com company needing to raise $1 billion. That's easy. But the truth is that there is a failure risk lurking, even for a company like Amazon in 2000, because it's a money-losing company with a business model in place. In fact, the Bureau of Labor Statistics, don't ask me why they maintain this database. I'm glad they do, though. Maintains a database of every business founded in the US, broken down by sector, and it tracks how many of those companies survive 1 year, 2 years, 3 years. So it's in the public domain. They update this every year. So this is actually from a 2007 study. You can go and pull up the 2024. It's not that different. It tracks the number of companies that survive 1 year, 2 years. So basically, you take natural resource companies. For every 100 companies started, 82 companies make it through, I think 82, right? 82 companies make it through year 1. You keep going, by the time you get to year 10, less than 35 to 36% of companies are left. I mean, what all this graph says is a lot of companies fail. The second is your failure rate gets smaller the longer you survive. So if you're valuing a company that's just been started, your failure risk can be 70%. If that company makes it 3 years, your failure risk has decreased simply by surviving. Failure risk is higher for small companies rather than large companies. So essentially, those are the things you think about with failure risk. So as you're working in your DCF, and I hate to push that in there as well, but if you turn in your DCF by Friday and you've got these negative cash flows for the first 7 years, I check your failure rate because that's an input. And if it's 0%, one of the comments you're going to get back is, hey, that's a lot of negative cash flows the next 7 years. Shouldn't there be some failure risk? You either make that part of your story as to why there's no failure risk, or you make a failure risk that's consistent with your own cash flow estimates. And there's the 2019 update. Things haven't gotten better. They actually have become a little worse in terms of the percentage of companies that make it through to year 10. Any questions on failure risk? So I finished this. Yeah, go ahead, David.
You said don't have a growth after 10 years, which is bigger than risk-free. Can we have a number which is lower?
Oh, absolutely. The cap is the risk-free rate. So there's nothing that stops you from it being at lower, zero, or even negative, right? So depending on the business. So let's talk about, so I finished this DCF, I come up with this $35 and I'm ready to log off. When one of the people in the audience, perhaps somebody who owned Amazon stock, asked a very plaintive question. She said, is it possible that Amazon is worth $84 per share? What's the answer to that? Oh, possible is such a weak word. In fact, I did this what if analysis just to deal with that question. What's driving my value per share? Revenue growth and margins, right? I'm using 42% revenue growth and a target margin of 10%. So basically, I have different revenue growth rates from 30 to 60%, margins from 6 to 14%. It's like a break-even table. See the shaded numbers? Those are all numbers that exceed the $84. So what has to happen for the value per share to be higher than 84? Well, revenue growth has to be 55% and margins have to be 12%. There's a book called Expectations Investing by Mike Mauboussin, one of my favorite writers and thinkers. And basically that book does this, instead of doing a DCF value and comparing the price, they actually come up with expectations that justify the price. And they reframe the question. Are you comfortable with 55% compounded revenue growth? And in other words, are you comfortable with Amazon growing like Walmart and having margins like Ann Taylor? And you say, that's okay, I can live with that, and you should buy the stock. So it's actually an exercise. Those of you come up with a value per share that's much lower than the price, rather than beat yourself up and try to get the value of the price, just play the game of what has to be true for NVIDIA to be worth $900. Then ask yourself, am I willing to make that my base case, that they need $1 trillion in revenues and a 50% margin? Now, as you're doing all of this, what's the question you keep asking yourself? Could I be wrong? Could I be wrong? I'll save you the trouble. You're definitely wrong. In fact, you're wrong 100% of the time. Why? Because you're estimating the future. Who really knows what the AI market will look like? You're making your best estimates. Does that bother me? Not in the least. You know why? Because everybody else is also trying to do what I'm doing. They're all in the same position. And here's the saving grace. You don't have to be right to make money. You just have to be less wrong than everybody else. It brings down that anxiety of, could I be right? No, basically all you have to do is be less wrong than everybody else. That's basically all you try to do in valuation. Being right is an impossible reach. You cannot get there, but you can try to be less wrong than everybody else. Any questions on any of the things we did? So in 2000, when I valued Amazon, I found it dramatically overvalued. And I didn't sell short, as I said, for all the reasons stated. A year later, CFA came back to me and said, will you do another webcast on .com companies? We're a very different point in time. The .com boom had bust. And the question they wanted me to ask is, will any .com company ever be worth money again? Sure. So I revalued Amazon in 2001. My value went from $35 down to about $20, $22. You're saying, that's terrible. Your value changed that much. But stock price though went from 84 to 11. Stock went from being massively overvalued to dramatically undervalued. And I was trapped. You know, I was trapped, right? Because when I finished that valuation, I was asked the question, are you buying? And now I couldn't do the dance of 6 weeks. So I bought Amazon for the first time in 2001. I bought Amazon 5 times. I've sold Amazon 4 times. So it kind of tells you where I am with Amazon right now. But this again is why you can never use the word never in investing. I've heard people say, I will never buy NVIDIA. You might not buy NVIDIA at 900, but you'd buy it at 90, right? And you can have a stock as successful as NVIDIA, but if you look at NVIDIA's history over the last 20 years, there have been at least 3 or 4 times where it's been significantly undervalued. Yes, Dor.
What was the main cause that your valuation
But between 2000 and 2001, the dot-com boom bust. So now you have failure risk coming in, right? Second is the retail market, the online retail market's inexorable advance into retailing slowed down because of that, of that correction. So
Did that change your vision of how the future will be or how the?
both, right? It
like the-
it changed my vision of what they can pull off. It, basically, and the pathway to profitability became much more rocky as well. So all those things played in. I think the end revenues didn't change that much, but the margins I saw went from 10% down because you could see how much margins were being affected in retailing. So that was a particularly eventful year. But even in that particularly eventful year, you got only a 30% drop in intrinsic value. Prices were collapsing by 80, 85, 90%. Yes, sir.
The personal preference, but what would you use as like your margin safety, I guess, when you figure out the value per share is?
Yeah.
The price seems to be lower.
Have you heard of this margin of safety? Seth Klarman wrote a book that you can't buy anymore. I think you got to pay $50,000 to find a copy of the book. He deliberately, I think, he's bought every copy and he keeps it in his house, I think so. But he talks about the margin of safety. Justin, help me out here. What's the margin of safety?
Well, I got it from security analysis.
But tell me what it is.
It's a difference what you buy it for, between what you think it's worth.
Think it's what? So first, when people say, why, I've heard people ask, why don't you use a margin of safety instead of a beta as a risk measure? What's wrong with that question? You said margin of safety is the difference between what you paid and what you think something is worth. To get what something is worth, you need a risk measure. So it's not, it's an after your DCF question, right? And margin of safety basically says, I could be wrong on my DCF, so I would buy the stock only if it is 20% lower. So at first sight, the larger the margin of safety, the more conservative you're being, right? It's good, right? But remember in statistics, we talk about type 1 and type 2 errors. You see why this plays out in margin of safety? By having a larger margin of safety, what do? You avoid buying stocks that are really overvalued because, but is there a type 2 error you're creating? You're not buying stocks you could have because you put the margin of safety in. Which one's going to dominate? Depends on the world you live in. If you live in a world where we have hundreds of undervalued investments, you can afford to have a big margin of safety and get away with it. That's not the world I see out there right now. I'll buy things at 5% below value if I can, because my opportunity set is dry. You know, one of the tests to run, and somebody says, I love margin of safety, I use a 40% margin of safety. Ask them one question. How much cash do you have in your portfolio? If they say 60% of the portfolio is in cash, my answer is stop the stupid margin of safety thing. It's not helping you if most of your money is in cash. So would I like to buy things at well below value? Absolutely, right? But whether I'm going to impose that as a requirement will really depend on what kind of opportunity set I face out there. Yeah. One of the things I try not to do just for my own sanity is actually look back at forecasts I made. But since I've been valuing Amazon so long, I've reached a point where I can look back and look at my 2000 valuation, look at the actual numbers to see how close or far away I was from the numbers. So in 2014, I went back and looked at my 2000, the original $35, the optimistic valuation. There's my forecast in 2000. There was the actual numbers each year. My forecast was that they would get to 40 billion by 2010 and to about 51 billion by 2013. They actually got to 85 billion. So let me take this each part of the story. So my original story, what have I learned by looking at the actuals? They're scaling up a lot more than I thought they would. It's a much bigger story in terms of revenues. That's the good news. On my margins, I was forecasting they would get to 10%. They actually got to, they were moving in the right direction till about 2010 or 11, and then they started reversing and going back in the other direction. Their profit path just got a lot more rocky. My 2013 story for Amazon reflected the change in Amazon from being an online retail company to what I call a disruption machine. That's what that second phase was. They were saying, look, no, it's not retail we're going after any business that is soft that we can target. So as you look back, you're not looking back to beat yourself up. You're looking back because you want to learn from that to reorient your story. There's nothing I can do in hindsight. I can't go back and fix things in 2000, but I can reorient my story based on, and Amazon to me remains much more difficult to value than an NVIDIA or any other company, simply because you don't even know what business they're in, right? And that's increasingly become true over the last decade, is they're in every business they conceivably can target as a potentially soft business. Shruti? At this point, I just use the beta of one. I mean, you're in every business. I think the beta is the least of my worries, right? And let's face it, with an Amazon, the cost of capital, I mean, it's probably going to be around 8.5 or 9%. This is not, that's my big issue is what's the revenue growth? If you're going after every market in the world, you could keep growing at double-digit revenue growth, even though you have 600 billion in revenues, right? That becomes really the, so it's an interesting story, because at this stage, the question you're asking is who can stop them, right? And what's the answer to that? No company going head to head against Amazon is one. So what's the force that'll stop them? Governments and regulations. And guess who's going to go to the governments and regulators asking that Amazon be stopped? And this is the hypocrisy of big companies, right? They talk about not liking government regulations and restrictions when they're put on them, but they're perfectly fine with it being put on a Facebook or an Amazon. So that's, I think, the wild card in the story is, will regulators and governments actually, and you can see in the antitrust, and Apple's already been targeted, that Amazon, they're trying with Amazon. It's kind of difficult to get antitrust laws to work on Amazon, because who's going to complain about $139 Prime membership saying that was too much? Yeah. So it's actually a tough business to target in the antitrust base, but it's become the biggest challenge to maintaining the model. So this is actually, I forget which year this was, 2000 something. Doesn't even tell the year, probably 5-6 years ago. So the disruption machine story. You can see that even though the revenues, 208 billion, you're basically still going to grow at 15%. And I'm looking at my updated valuation, you still have the same phenomenon. Huge revenues, still managing to grow. Maybe not 30, 40, 50% a year, but 10, 12, 30, which is an accomplishment at those levels of revenues. I mean, my initial story for Amazon was a field of dreams company. That is, if we build it, they will come. The revenues, the profits will come. I think you're finally starting to see the margins. I mean, Amazon last year, for the first time in its history, delivered higher margins than the retail industry overall. And in fact, those margins are deceptive, because those margins were after $22 billion in shipping subsidies. You know, the shipping subsidies come from, right? Your Prime membership, you know exactly where they come from. It's a free shipping. They actually, if you look at the footnotes, they tell you exactly how much they spend on the shipping subsidies. So those are the things that I think you're seeing is changing in Amazon, is finally they're making money on these multiple businesses, and they have market power. I mean, that's a reality. The fact that they don't use it doesn't mean they don't have it. So let's move on from growth companies to mature companies. Yeah.
I saw on the previous slide you had probability of failure. Curious how you calculate that.
Zero. You're
feel
making
zero
money.
way of this,
No.
Otherwise,
No, but if you have a rating for your company, can you, if so many of these companies have a bond rating, can you go from a bond rating to a probability of failure?
no.
They have a history of bond ratings, right? Triple B, double B. If you go back in time, I can tell you what percentage of double B rated companies go bankrupt within 10 years. Ed Altman, who used to teach, used to keep that database every year. Now I think Merrill and S&P report that on an annual basis. You can go in each year, they do an update, but they give you the ratings and they give you the likelihood of failure over the following 10 years. So you got a rating, you got a probability of failure that goes with it. Let's talk about mature companies. Mature companies should be the easiest to value, right? Long history, established business models. The only problem is they have habits, but can you fall into bad habits? No, we all do, right? There are things we do every day. We know we shouldn't be doing it. Stopping for those French fries at 3 o'clock as a snack. Not a great idea, but we've done it every day for 15 years. And we haven't visited a cardiologist, so we don't care anymore. There are lots of things you fall into doing. that are not good, but you do them. Mature companies are the same way. They're grounded, they're stable, they're doing the same thing, but sometimes you can stop and ask, does that make sense anymore? So with mature companies, the questions you ask come with two sets of answers. So when I ask you, what are your cash flows from existing assets? You can give me what the answer is with existing management and existing practices. And then you can give me a different answer. If somebody else ran this company, the numbers will be very different. So think Nelson Peltz versus Bob Iger, right? You can ask them the question, each of the four questions, you're going to get very different answers. What's the value of growth? Bob Iger is going to give you one plan and one value, and Nelson Peltz might give you a very different vision for the company. How risky is the company? Again, as a mature business, you're going to get one answer. So you almost get two sets of answers, and trying to incorporate both into one valuation is almost impossible to do. It's almost like you have two scenarios, one with the existing management running it, and once with this replacement. So guess what you have to do, value mature companies? You've got to value them twice. So I'm going to take an example, a company called Hormel Foods. Heard of it? Its most famous food, its most famous product is perhaps the most disgusting thing I've ever seen in my life. It's called Spam. Spam is slimy looking, I don't even know what to call it, meat-like thing that comes in a can that can outlast a couple of nuclear wars. How you keep meat edible for 200 years, I don't know, but Hormel mastered it. But you know what? During the Second World War, Hormel created Spam as a solution to a problem. The problem was you had hundreds of thousands of soldiers who had no food to eat and they needed meat, and Hormel found a way to get the meat. So the original US Army, as it was flying people back to the US from Japan, stopped in Hawaii. And Hawaii in 1945 doesn't look like the Hawaii today. There were no restaurants. You basically ate sugar cane and whatever else was in there, but you didn't have enough to feed. They got Hormel to deliver Spam. So Spam is it's a food processing company, originally family owned, increasingly it was a family run, then now it's a company where the family is gone. They have a foundation like Hershey's. And it's a company that's very traditional, very conventional. So the first thing I did was I valued Hormel with their existing management in place. Very conservative management. They've been running the company the same way. Very low reinvestment, very low growth. The company seemed to be unaware that a world existed outside the US. So they're very US focused. So low reinvestment, low growth. And they used almost no debt. Why? Because they didn't like that. So that was my status quo valuation. Low growth, low debt ratio, cost of capital that reflects it. Value per share of about $32. Then I asked a what if question. What if Hormel were run differently? More aggressively going after growth, not huge growth, but some growth. That'll require reinvestment and settling for lower returns on capital. So this trade-off here, accepting projects that earn more than the cost of capital, but less than what you used to make. And a higher debt ratio. And I'll talk about how I picked the 20% debt ratio, but basically a slightly higher debt ratio. The value per share that I get is $38. So I have two values for Hormel. $32 is the value per share with the status quo. 38 is the value per share with somebody else running. Say you're an investor interested in investing in Hormel. You don't know which of these scenarios will play out. You have a price. Let's say the price is at 33. If you compare it to the 38, it looks cheap, but that's with new management running it. Compared to the 32, it looks expensive. You're saying, which one should I do? It's an expected value, right? The expectation is going to be driven by the chance of change here, and that chance of change is low. You know how I had to assess the chance of change here? Actually, look at the shareholder structure, and there were no vote. Thank God there were no voting and non-voting shares. But the biggest shareholder in Hormel is the foundation, the family foundation. It owned 23% of the shares. So I said, maybe the Hormel Foundation will push for change. Let's see who runs the Hormel Foundation. So I went in and my hopes dropped right away because it looked like the Hormel Foundation's head was Hormel's CEO. The way they'd structured it was the CEO for the company was also the chair of the foundation. Now, chance of change is not zero because Hershey's had the same structure. Eventually change came about, but it's low. So when you look at mature companies, you're going to have to make a judgment So if you're valuing Disney, you can do the status quo first, because there's no point playing games. But then if you want to change the target debt ratio, change the mix of businesses, less in streaming, more in streaming, you can essentially act like you're running Disney and ask what the value would be with somebody else running it.
How did you get to 10% chance of change of management?
Well, basically, it's close to zero, right? It's the only reason it's not zero is if the foundation ever changed, which is what happened in Hershey's. The foundation eventually said, we're getting too little from because the foundation's entire wealth was tied up in shares of Hershey's. They managed to push for change. So the CEO's got to be replaced. There is some chance of it happening, but it's not going to happen in the near term. That's why, I mean, in a sense, it's low or high. That's whether it's 10 or 15 is not going to make much of a difference. Whether it's 10 or 80 will. You know what could change that 10% very quickly is if a Carl Icahn targeted Hormel. That's what activist investors, they change the likelihood of management.
But
being
over here,
replaced.
there's no mathematical basis to get.
There's no math,
Okay.
but even if there's a mathematical basis, it false precision, right? How do you mathematically estimate something that can happen? If you wanted something more quantifiable, you can use statistics to estimate what's called, have you ever seen you know how a regression is run, right? You take a dependent variable, independent variables. There's something called a probit in statistics. We can estimate the probability of something happening. So you take all companies, you take the number of companies where management changed, and then you look at fundamentals that might cause the change. How many what percent is held by insiders, and then you run what looks like a regression, but what you get instead is an equation where you plug in the numbers for your company, you get a probability of change. It'll make you feel more comfortable because it's more quantified. But the truth is, that's exactly where you are when you make these judgments based on what you can observe about the company. And on the issue of debt, don't fall into the trap of assuming increasing debt ratio always lowers cost of capital, because it doesn't. In fact, for those in my corporate finance class, we're going to spend some time on this discussion. As you change your debt ratio, your cost of equity will change. Why? Because it's a levered beta. As you change your debt ratio, your cost of debt will change. Why? Because your interest coverage ratios will decrease, will become riskier. Your cost of capital is a weighted average of those two numbers. So at least for Hormel, initially, adding debt helps you, right? 6.7, 6.8, 6.59. In fact, their optimal debt ratio is between 20 and 30%, but there's not much that you benefit beyond 20%. So the optimal debt ratio I ended up using in my, So don't arbitrarily replace the debt ratio at 90% and give them a really low cost of capital, because that's not the way the world works. So dealing with young companies, dealing with mature companies, let's talk about that depressing scenario of having to value declining and distressed companies. You can ask the question, you're a declining company, and ask you, what are your cash flows from existing assets? And you show me a history, what do I see there? Declining revenues, margins under pressure. Doesn't look good. Then I ask you, what's your value from future growth? Say, what future growth? That's in the rearview mirror. In fact, your future might be that you shrink as a company rather than grow. Your margins might continue to drop. How risky are you as a company? Clearly, two things are happening here. One is your operating business is shrinking and changing over time. And if you're not careful and bring down your debt proportionately, your distress is going to rise. So, and when will you be a mature company? You said that was 20 years ago. I'm now beyond mature. The question is, maybe I'm heading towards liquidation. There's a very real chance in these companies that the end game is not a terminal value. It's a liquidation. You're valuing a brick and mortar retail company. Bed Bath and Beyond, I valued 2 years ago. You construct your story, you play out the numbers. There's nothing happy about those numbers, but it reflects the reality of things. Some business stories can be horror stories. Not all fairy tales, happy ending at the end, because it is what it is. So when we talk about dealing with decline, the first thing I often think we struggle with is psychological. Lambert said he used negative revenue growth as he shrunk the company. You know how difficult it is psychologically to put a minus on your growth rate? It just seems unnatural. Now, I've asked people who've been valuing companies for 40 years, when was the last time you valued a company with negative growth? Most of them have never done it. I said, that's weird. Because there are companies out there that shrink and go away. How come you never seem to encounter these companies? The answer is you do, but you act like you don't. So some of this is psychological. But the end game in value here is a function of who runs the company. We talked about good and bad management. If you're at a declining company, there's a story about GE that I saw in the Wall Street Journal a couple of days ago. It was actually not a complimentary story, but it was a story about how, the CEO of GE has broken up the company. Let's talk about how this empire built up over 150 years is now. He did exactly what he needed to do, which is this is a declining company. You're run by good managers. You should be focusing on shrinking the company, liquidating yourself over time, and going away. There's no glory in surviving for the sake of surviving. That'll make sustainability people pissed off, but let them be pissed off. It's not their company. It's not their money. But if you're run by bad managers, what do you do in a declining company? You fight decline. By doing what? You do acquisitions, you make yourself, you spend tens of millions of dollars in consultants, you try new strategies. The end of the process, you still die, but you die poor. You've given away all your wealth.
You have a situation where the operating margin is increasing, but revenues are decreasing.
That's fine. You can that you can live with, right? Basically, you have an addiction. Let's say tobacco companies. That's exactly why they've been able to survive. Is revenue growth has become negative because young people don't smoke, but the addicted people still need to smoke. So the margins have actually stayed healthy. Whether they've increased or not depends on what part of the world you look at. So that actually is an easier scenario where you shrink, you collect your profits, and when the last smoker dies, you shut the doors and you leave.
I think more of a business that's like very dispersed as they focus on.
Exactly. There might be a subset of the business. That might be your hopeful end game is I make my company smaller, and after I made it smaller, there will be people who will come to that smaller company of mine.
We would consider that niche. We would consider that distress still.
It'll be distress when it starts, so declining. Declining and distress don't always go together. You can be declining and not distressed. You can be declining and distressed. You can be growing and distressed. So distress is I've combined the two here because when both come together, you have a really bad combination. So here's my evaluation of Bed Bath & Beyond. Have you guys been in a Bed Bath & Beyond? It's kind of a strange place, right? You walk in and say, what do these guys sell? You're saying Bed Bath & Beyond, they must sell sheets. Yeah, they do sell sheets. But they sell gadgets, they sell carpets, they sell food. This is like, a little bit of this. And for a while, they were an incredibly successful concept. Shows you how in retailing, you don't have to be a good concept to be successful. You just have to be something that appeals to a subset of the population. I mean, I used to live about 5 miles away from the very first Bed Bath & Beyond. It's not that old as a company. Now, of course, that concept soared in the 90s, they grew, and then as brick and mortar retail has suffered, they've suffered with it, perhaps more than the typical retailer because they have no niche customer base. Right? So this was a valuation of Bed Bath & Beyond in September of 2022, and their revenues had gone from 14 billion 5 years ago to about 8 billion. So the revenues had shrunk, their margins had turned negative. So clearly, this is a declining company in trouble. So I mapped out what I thought was my upbeat scenario, that they would continue to shrink, get smaller over time, but eventually they would get to a point where they had a niche business, as Justin would describe it, of people who like Bed Bath & Beyond stores. And I would try to stay away from those stores because those people might not be the people you want to hang out with. But there's a subset out there that I love Bed Bath & Beyond. I really miss that store. So the end game here is that they become a smaller company that is able to find its footing. So you see revenue shrinking over time from 7.9 billion down to 5.9 billion. As they shrink and find their niche business, their margins improve, not to some magical number, but to basically the average margin for the sector. And the reinvestment, and this is what we were talking about earlier, Lambert, is as they shrink, I have negative reinvestment. What does that mean? They're divesting businesses. Now, this you want to stop and make sure that it is practical because it might turn out that divesting, Bed Bath & Beyond shrinking is basically shutting down stores. What I'm estimating here is the cash flows they can collect from lessors who are glad to see them leave. If you don't think they can get any cash flows as they shrink, you should probably replace those negative reinvestment with zero, saying, I'm going to shut down and have nothing to show for it. So that negative reinvestment is actually helping them. But the end product of this story was I gave them a likelihood of failure based on their rate. They were double B, single B rated. That's a 23.74% chance of failure. Value put for $3.23. Stock was trading at $8.79. Since then, the story's gotten darker and pretty much, I think they declared bankruptcy last year. So clearly the end game is here. So when you're valuing declining and distressed companies, don't be shy about putting in a negative revenue growth for the next 5 years, the next 10 years, even forever. Don't be shy about replacing terminal value with the liquidation value. And when you see negative reinvestment, stop and ask the question, will I actually be able to get cash flows when I make my business smaller? What am I divesting? Which brings me to that downside of distress when you have debt. So if you're a money-losing company with a lot of debt, there is the sword hanging over your head. And as I said, traditional discounted cash flow valuations are not designed to deal with that kind of risk. You know what the pushback I get from people who do DCFs? Why can't I raise my discount rate? Seems like an obvious solution, right? The problem with discount rates is they're blunt instruments. They were designed for going concern risk, and the risk you're worrying about is there will be no year 3. I don't think there's a way around it. If you have distress, you got to estimate a likelihood of distress, and as Gandhar pointed out, not an easy number to estimate, but a number you can estimate by looking at the ratings if you have a rating. If you have bonds traded, even better. You can use the bond price, and I'll talk about how you can use it to back out a probability of failure. But if you don't have either of those, and you really want a quantifiable model, you got to build a statistical model yourself. But that failure likelihood and what you will make if you fail become key ingredients in valuing your company. So I'm going to try this. And this is a very old valuation from 2009, February 2009, a company called Las Vegas Sands. You know what they do? A casino company. I'm going to generalize here, but casino companies tend to be run by megalomaniacs. And you look across casino companies, it seems to be a common feature. And there's a reason that becomes part of the story. In 2009, Las Vegas Sands was owned and controlled by a man called Sheldon Adelson. He owned 52% of the company's shares. And in the decade leading into 2009, Las Vegas Sands had been one of the fastest growing casino companies in the world. If you've been in Singapore, they had the Marina Bay Sands, which is this huge hotel that looks like a boat. They had, Macau, they had a Sands casino. So they were building casinos all over. You're saying, so what? If you've driven by a Vegas casino, these are huge, huge, huge infrastructure investments, right? Hundreds of millions of dollars. I don't know how much the Bellagio cost, but I've been lost multiple times to the Bellagio trying to find my way to a room. There are like 26 restaurants in that damn place. Costs you hundreds of millions of dollars. So you need capital. You can raise capital by either issuing equity or issuing debt. What do I describe casino companies as being run by? Megalomaniacs. What do megalomaniacs value? Control. Sheldon Adelson owned 52%. He didn't want to issue shares because we're dilute control. So guess what he used to fund all those casinos? Debt and more debt. And when times were good, people celebrated. Then, of course, 2008 hit, the bottom fell out. Casinos lost customers because people are not coming to gamble. And in addition, that debt they took on was now potentially becoming dangerous. In fact, this valuation, the time that I did this in February 2009, was in the midst of talk that Las Vegas Sands would not make it through the next 6 months. So that talk is going around. I decided to do a discounted cash flow valuation of Las Vegas and shutting all that talk off. So put my optimist hat on, cover my ears, and fix the company. What did I do to fix the company? First, I assumed that eventually customers would come back to casinos when times turned good, that the margins which were low would revert back to where they used to be. So basically, I'm assuming mean reversion in those. And by the time I get to year 10, Las Vegas Sands is fixed, at least in my spreadsheet. Nice, healthy company, big terminal value. I come up with a value per share of $8.12. So what have I valued? I valued what Las Vegas Sands will be worth if they make it to steady state and become this healthy casino company. So it's a realistic valuation for that scenario. But remember decision trees from whatever class you might have taken, operations, research, statistics. Decision trees, you have 2 branches, right? You survive, you don't survive. I've estimated the value of the survival branch. Now I have the failure branch. In the case of Las Vegas Sands, I could have used the rating. The rating was B plus, which have given me a probability of failure of 28.25%. That's always available. But I'll give you a neat way in which you can estimate likelihood of ratings, if nothing else, to impress other people, even if you never use the number. You know how we usually price bonds? How do we usually value bonds? Forget pricing. How do we value bonds? What do we do? What's the process by which we value bonds?
Supposed to take like the present value.
Of the coupons and the face value, the promised cash flows, we discount them back at a discount rate that reflects the likelihood of default, right? The higher cost. What we get as the present value is the value of a bond. That's one way to do it. I'll give you an alternate way to value a bond. You can take the expected coupons and face value. You say, what's the difference in for the promised cash flows to be delivered, the company has to be around, right? So I take each promised coupon and I multiply by the likelihood that you'll be around to pay the coupon. So you have the expected coupons. And then now that you've adjusted your cash flows for risk, what can you discount them back at? I would discount back at the risk-free rate. So I take the expected coupon. So basically that's the equation. There's the promised coupon, promised face value. Let's leave the probability of distress as an unknown, and the risk-free rate is known. The price of the bond was $529. So 7-year bond. I knew the coupons, I knew the face value. The only thing I don't know is the probability that they won't make it, right? If you ever used to solve a function in Excel, you basically say, try different numbers, come back to me and tell me what the likelihood is. And I got a scary looking number with Las Vegas Sands. That equation told me there was a 77% chance that Las Vegas Sands would not make it. That's what deeply discounted bonds mean. So when a bond trades at well below par, that's a bond market yelling, this company will not make it. It's true, I'm trusting the bond market on this dimension, but let's face it, at least those guys are focused on one thing and one thing alone, which is default. They're not getting distracted. 77% of the time they won't make it. What happens? They don't make it. They'll have to sell the casinos. Who will they sell them to? Are you in the market for a casino? It costs a couple of billion. I don't think I can handle that. So you're going to sell it to Steve Wynn. He's in trouble too. Here's the problem. When businesses get into trouble and everybody else is in trouble, there's no potential buyer. I estimated the distressed sale proceeds by just taking the book value of the casinos, which were appraised to be whatever the market value was, and taking half of that. You could have used the whole amount. You still wouldn't have changed the answer because that was still less than the debt they owed. The bottom line is, if they're distressed, my equity is done. It's worth nothing. There were some companies, the equity is worth something. Here it's worth nothing. I take the expected value, the $8.12, my DCF value times this 23% or 24% of the time. That's true. Plus 0 times the 77%. My expected value bringing in distress is $1.92. Do not use this if you have a single A, a double A, triple A rated company, but you can see as companies slip down and you worry about default. And that's why I built that failure probability into the spreadsheet, is to give you a chance of saying, hey, so that's why if it's 10%, you ignore it, it's not going to be the end of the world, but if it's 50, 60, 80%, that's when it can tip the scales. Yes, Jared?
How would you do this if it was a startup that could already
That's much more difficult, right? Because you don't have the bond market, you don't have a rating. All we have is age. So we know that younger startups tend to fail more than old, because the more years you are as a startup, it turns out that you probably, so if you look at the Bureau of Labor Statistics graph, 1-year-old companies have about a 70% chance of failure. 3-year-old companies, that's dropped to 47 or 48%. First, I'm going to look at the age of the company. Second, should I look at the size of your startup? If you're a startup that's attracted more capital, $1 billion in capital as opposed to 10 million, your chance of failure magically went down. You know why? Those people with $1 billion in capital invested in you will supply you more capital because they want to write off the billion. It's kind of an unfair process. I'm going to look at how the age of the company, I look at do I care about your background as a founder? If you founded other companies in the past and taken them public, I say, look, this guy knows how to get the startup to business. So now you can see why venture capitalists, to me, what the skill set of a really good venture capitalist is being able to assess the likelihood of failure better than the rest of us. If you do that, you're going to come out ahead of this game, right? So, and this is why I think, at least in venture capital, there's more survivor, more continuity. The most successful venture capitalists earn much higher returns for an extended period, unlike an active investor. Why? Because if you're a big name venture capitalist and you supply capital to a company, just your name alone increases the likelihood of survival, because they can now use this to raise even more capital from other VCs saying, hey, we got venture capital from Benchmark Capital. They know what they're doing. So all those factors come into play. I wish I could give you a mathematical way of getting from that to a percentage. You just have to assess, is this by the time you value a startup at the time, you take it at the time it goes public, you're past the worst risk stage. At this stage, you're just looking at, tens, failure rates of 10, 15, 20%, not 70, 80, 90%. Yeah. Yes, Dave.
So let's say I'm an outside investor with a lot of cash.
Yep.
And I'm looking for an opportunity. Do I buy the company and pay the debt, or do I wait for the company to go into bankruptcy and then renegotiate the debt, or not pay any of the debt?
Well, you'd like to pay the debt at market value, right? The problem is the market value of debt reflects the risk that they will not. The minute they hear you're buying the company, guess what happens to the market value of that debt? It's going to pop up, right? That's part of the problem. As an acquirer, it's very difficult to buy.
For it,
In a sense, yeah. So yeah, you almost have to wait for that to kick in, because otherwise the debt will magically adjust up and your equity value will become smaller. Yes.
You have a company with no debts or no rating. You take like other businesses that are in the same sector and kind of like average what their bond ratings are to get like that.
Yeah, you could try. I mean, let's face it, we're desperate at that point, right? I'll do anything I can to put a failure rate, because I've heard people say, but I don't have enough information to come up with a failure rate. I'm going to leave it blank. That's an assumption too, right? A 0% failure rate is an assumption as well. So anything beats nothing. So I'll take whatever I can to make that judgment. Let's talk about emerging market companies, right? Say, I'm asking the 4 questions. What are your cash flows from existing assets? What's the value of growth? How risky are you? When will you be a mature company? With every one of these questions with an emerging market company, you will want to learn about the company, but then what do you ask? You ask about the country. You're investing in an Argentine company. Argentina is lurking in the background with every single one. I mean, it's one reason why I'm so uncomfortable valuing Chinese companies is there is a government effect. It's not a worry about distress or risk. It's a fact that the government is part of my story. So when I look at emerging market companies, there are a few things that I think you might want to keep in mind if you're valuing an emerging market company. The first is there is country risk, but don't use it as a bludgeon. Don't take every. So if you go back and think about how we thought about equity risk premium, this is why I said don't look at where a company is incorporated, where it does business. Whether you use lambdas or whether you use a weighted average equity risk premium, not all Indian companies are equally exposed to Indian country risk. So you got to bring it into your valuation, primarily through the discount rate. There's no other place to do it. And the question of how to do it would depend on the company. Second, don't get too focused on what currency should I do it in. You can't take a risky company. I've seen people actually in Latin America in particular, they value Latin American company and they'll see this US equity risk premium. So what happened here? So we've dollarized the cash flows. I said, tell me again what that means. No, we took every cash flow and converted dollars. So basically when you did that, all the country risk went away. Right? Doesn't make any sense, but you can see people thinking that currency can fix problems, but currency is just a scaling mechanism. If you do this right, you should get the same value for your company in different currencies. So this is a valuation I did for Infosys, I think about 10 years ago. I valued the company in Indian rupee terms first. So actually I was in India, did the valuation and all the numbers. So it was a 2-stage, discounted cash flow model, free cash flow firm. It came up with a value of 614 rupees. And somebody in the audience asked, what would have happened if you'd done the valuation in US dollars? I said, okay, let's play it through. I have the spreadsheet here, let's work it through. Let's start with the good news. When I go from Indian rupees to US dollars, I have a lower cost of capital. Why? Why do numbers vary in different currencies? And why do we have a lower risk rate? No, less risk, less inflation, right? Basically, so lower inflation, so I have a lower cost of capital. So that's a good news. The bad news is when I do my growth rates, they too will be adjusted for exactly the same reason. And if I play it through the value per share that I got with the lower cost of capital and the lower growth, it's not magic. If you look at the math, basically I'm taking a 7% inflation rate and 3% and doing it both in the numerator and the denominator. The value per share I got was $12.79. Converted at the exchange rate then, it would have been exactly the same number as using 614 rupees, the Indian rupee valuation. So if you do things right, currency should not make a difference. And finally, on the corporate governance issue, we kind of dealt with it. You're doing the discounted cash flow valuation. Don't act like it's thrust upon you. You're the one making the estimates of growth and cash flows and return on capital and margins. If you think the company is badly managed and there's no chance of change, you know how it's going to play out? You're going to give them low margins and low returns on capital effectively in perpetuity. You can have, remember in terminal value, we said if you earn less than the cost of capital, growth will destroy value. You might have, in a company with bad corporate governance, growth with return on capital less than the cost of capital in perpetuity. You're destroying value, not just on existing assets, but on future growth. That governance discount should already be in there. So I'll leave you with one final example. About a long time ago, I was asked to value a company called Tube Investments. It's a South Indian old-time company. It makes tubes. And you know, it started off with that. It's a pretty diversified company now. It's a family-run company. And I've known the family since I was a little kid. So when they said, can you come in and value the company? I could not say no. So I valued the company. And essentially, I'll go through this valuation. They called me in because they felt the market was being unfair to them. The market was pricing them at 102 rupees. They said that's 5 times earnings, which it looks really low. The market's screwing up somewhere. Can you see what it's missing? So I went in and I gave them a growth rate of 5.5% based on a reinvestment. So I looked at their history. They reinvested about 60%. The return capital is about 9%. And you can already see the seeds of what the market dislikes about them. Their return on capital is 9%. The cost of capital at that time, Indian rupee risk-free rates were much higher, was 16.9%. This was a company growing. So I put this up and I came up with 62 rupees, which is the opposite direction as to what they wanted. They said, no, maybe there's something we can do. Maybe you can grow faster. I said, oh, you want to try to grow faster? What do you think would happen if I made this reinvestment rate 80% and let them grow faster? It actually made the value 50. So the more they tried to grow, the lower and this was exactly the problem they had. They thought higher growth will make the market like us. And nobody was stopping and asked the question, what return on capital are we earning with that higher growth? If I'm an outside investor investing in Tube Investments, and this is what they're doing, I'm going to build in the likelihood that not only are they earning less than the cost of capital for the near term, since they don't even think there's a problem, they're going to keep doing this in perpetuity, the value per share reflects it. What do you need to do to fix it? First, you probably need to get in management that thinks differently. But in terms of practicality, please stop investing. Zero growth will give you a much higher value than the 5.52% growth. Take zero net present value projects. Is that asking for too much? So when you see badly run companies and badly managed companies, don't be too quick to fix things on your spreadsheet using industry averages or historic norms. Ask yourself about the corporate governance of the company because this might be baked in. I will see you on Monday for the quiz. On Monday, we'll actually finish packet 1. So, you don't have to do it right away, but sometime in the next week, download packet 2. Yeah.